All right, let's talk about prop trading. For so many traders, this is the absolute dream, right? Getting access to a huge pile of capital without having to risk a single dollar of your own money. It's sold as the ultimate shortcut to the big leagues. But what if I told you the entire system isn't really designed to find the next superstar trader? What if it's actually designed to profit from all the ones who fail? Let's pull back the curtain and see how this really works.
So, on the surface, the sales pitch is incredibly simple and, let's be honest, very, very attractive. A firm hands you their money, you bring your trading skills to the table, and you both split the profits. It really sounds like the perfect partnership. It seems like it's designed to solve the one problem every trader faces, not having enough capital.
But here's the twist. Here's where we have to get real. The material we're digging into today paints a much, much harsher picture. It frames prop trading like this. It's a risk business disguised as a trading opportunity. And you know what? That one little shift in how you see it, it changes absolutely everything. And understanding that is the real key to actually making it. Okay, so if we want to have any real chance of succeeding in this world, we have to stop thinking like a trader who just got a golden ticket. Instead, we have to start thinking like the business owner on the other side of the table, the one who's managing all the risk. That means we've got to understand their business model, not just our own P&L. And this is what's so fascinating. The prop firm's real competitive edge, their secret sauce, it isn't finding the next Paul Tudor Jones. Nope, it's their risk framework. It's an expertly designed, almost automated machine that is built to filter people out and control losses at an industrial scale. So how do they really make their money? Well, here it is. The revenue doesn't just come from that small percentage of profitable traders. It comes from the thousands and thousands of evaluation fees. It comes from traders paying to reset their challenges after they fail. They even make money monetizing platform and data fees. The evaluation itself, it's a profit center, specifically engineered to take advantage of our most common behavioral flaws. And all of this brings us to the rules. Now, most aspiring prop traders, they see these rules as, annoying obstacles they have to get around. But that is completely the wrong way to look at it. To win this game, you have to see the entire prop account for what it actually is, a system of constraints. This right here is the fundamental mindset shift you have to make. You are not being given money to trade however you want. That is not the job. You are being paid to operate profitably inside a very specific, totally non-negotiable set of rules. Your job is risk compliance first and trading second. Let's talk about the biggest, baddest rule of them all, the max drawdown. Now, a static drawdown is pretty simple. It's just a fixed price floor your account can't drop below. Easy enough. But the trailing drawdown, oh man, that is the real killer. It's a floor that actually moves up as you make money. This means it actively punishes you for giving back big chunks of profit. It is designed with surgical precision to eliminate traders who live and die by one massive lucky home run trade. And the constraints don't stop there, not even close. Daily loss limits exist to stop you from going on tilt and revenge trading your account to zero. Position size caps? They mean the firm, not your sudden burst of confidence, decides when you get to trade bigger. And those consistency rules are there just to make sure that your performance is actually repeatable and not just some lucky fluke. So when you put all these pieces together, the message becomes crystal clear. The entire system is built from the ground up to reward mechanical, disciplined, repeatable execution. Which brings us to this core idea. You have to win like a machine, not like a gambler. Okay, so we get it. The system is tough, the rules are designed to make you fail, but people do pass. People get funded. So how in the world are the few survivors actually doing it? Well, the answer is probably not what you think. It's all about focusing on a completely different set of metrics. This really brings us to the most important question we can ask. If all these rules are just filters, what are the firms actually looking for? What does a trader they want to give money to actually look like on paper? And I'll give you a little hint. It has almost nothing to do with your win rate. Seriously. You could have a 70% win rate and still be seen as totally, completely unfundable in their eyes. This table just lays it all out perfectly. On the left, you have the fundable trader. Look at that, a smooth equity curve, low drawdown, a high profit factor, which just means their winning trades are way bigger than their losers. And on the right, the unfundable trader. Wild, heart attack-inducing swings, high volatility, always hunting for that one big win that'll make them a hero. I'm telling you, a firm would rather fund the steady, consistent performer every single day of the week, even if their win rate is lower. So why do most people fail? It's because the pressure of the evaluation is a perfect storm designed to expose all these classic mistakes. Overtrading because you feel rushed, ignoring the rules, moving your stop loss because of fear, and the big one, averaging down into a losing position, which is an absolute death sentence with a trailing drawdown. This thing isn't just a profit test, it's a psychological stress test. So how do the pros, the people who actually make it, avoid these traps? It's not some secret indicator, it's not a magic strategy. It comes down to this one powerful concept: risk engineering. They don't just manage risk, they build their entire trading system around the risk parameters. And this is what that actually looks like in practice. This is where it gets really practical. The successful traders, they build their own set of rules inside the firm's rules. They adjust their position size based on how volatile the market is, not how greedy they feel. They have filters to avoid trading in choppy, dead zone market hours. They even program in automatic cooldowns after a big win or a big loss to stop themselves from making emotional decisions. These aren't just suggestions. These are real-deal survival mechanisms. Okay, so this leads us to the final and most actionable part of all this. How do you actually make this shift? How do you go from being just another gambler blowing up an evaluation to becoming a durable, funded trader who treats this like a real business?
Well, the very first thing you have to do is completely reframe the goal. You are not in a trading competition to see who can make the most money the fastest. That's the sucker's game. You are taking a risk compliance exam. Your only job is to prove that you can follow a set of rules under pressure. That is it.
So the path to actually making this work requires structure. First, you need a defined, repeatable setup. No more trading based on vibes. Second, you need a quantified edge. You have to actually know your strategy's statistics, not just hope it works. Third, you need hard risk controls that you physically cannot override in an emotional moment. And finally, you need the discipline to show up and execute with consistency, day after day. Look, at the end of the day, the real prize isn't just passing one evaluation. Anybody can get lucky once. The real goal, the pro's goal, is to build a trading process that is so robust and so disciplined that it can survive and spit out payouts for years to come. In this business, durability beats speed every single time. So let's wrap this all up with a really powerful two-part idea. The first part is a warning. If you treat prop trading like a game, like a lottery ticket, or a get-rich-quick scheme, the rules are designed specifically to find you and to break you. But, and this is the amazing part, if you flip the script, if you treat this like a serious risk-managed business, those exact same rules that break everybody else, they suddenly become your greatest advantage. They give you the structure and the discipline that forces you to become the professional trader you always wanted to be in the first place.